Since the global financial crisis erupted in 2008, the major central banks in the developed world have flooded the financial system with cheap money. How effective quantitative easing and other unorthodox policies have been in reviving the global economy is widely debated, but one thing is beyond dispute. The big four central banks, the US, Britain, Japan, and the Eurozone, have increased the size of their balance sheets dramatically. In January 2008, they held assets worth around 2.9 trillion US dollars on their balance sheets. They now hold close to $7.5 trillion. As the global economy recovers, that liquidity will eventually have to be withdrawn. In recent weeks, anticipation that the US Federal Reserve could be the first to take the step has unnerved financial markets. Yields on 10-year US government bonds, a benchmark affecting many other interest rates, have risen rapidly from historic lows and have recently surpassed 2.5%. Borrowing costs are still exceptionally low by the US's normal standards. The Fed has been at pains to reassure markets that it is not about to tighten monetary conditions suddenly, but investors are nonetheless anticipating just such a transition. In recent weeks, they have pulled their money out of risk assets, such as emerging market currencies and shares. The resulting sell-off has been dramatic. The process of eventually ending QE and restoring interest rates to more normal levels will inevitably be disruptive, but the moment of exit has not yet arrived. Indeed, the Economist Intelligence Unit expects the Fed to continue expanding its balance sheet, even if it soon starts to do so at a slower pace than before. By early next year, we think the big four central banks will be holding nearly 8.8 trillion US dollars in securities. Withdrawing much of that liquidity, when the time comes, could create financing problems for emerging markets. Some of these economies rely heavily on volatile inflows of short-term investment, which can easily go into reverse. Fortunately, emerging markets look better placed to withstand capital flight than in the past. Their balance sheets are much stronger, and they have built up huge buffers of foreign reserves in recent years. For example, in 2000, the aggregate international reserves of non-OECD countries were equivalent to only 45% of their foreign debt. Now the ratio is 155%. We still expect more volatility in the next 6 months, but emerging markets and the world economy should be able to weather the storm.